I have been investing in stocks for last 12 years. $500,000 portfolio, 20% average annual return. In that time, I have only shifted to a large cash position twice. And the second time is right now. In March 2000, Cisco was the most valuable company on earth. 280 times earnings. 18 months later, it was down 86%. It took 20 more years to get back. Now look at Nvidia, $5 trillion market cap, same structure, different technology. Warren Buffett has watched this setup his entire career. Right now, he is sitting on more cash than at any point in Berkshire's history. In this video, I am going to walk you through the specific 4 warning signs he is watching right now. Each one has a number attached, and I will show you exactly what I am doing with my own portfolio because of them, including the one move I only make when all 4 are active at the same time. If you are holding Nvidia, Microsoft, Meta, or any AI stock right now, stay with me for the next 90 seconds. First warning sign, the number that's been right 3 times. There's a ratio that compares the total value of every publicly traded company in America to the size of the entire US economy. Buffett has called it the single best measure of where valuations stand at any given moment. When it's low, stocks are cheap relative to what the economy actually produces. When it's high, stocks are priced for a future that hasn't arrived yet. In December 2001, Buffett wrote a piece for Fortune magazine. He had been using this ratio privately for years. That piece was the first time he explained it publicly. He pointed to a specific number. In early 2000, right before the crash, the ratio had hit 190%. He wrote that anyone watching it had a clear warning. The market was priced at nearly twice the value of everything the US economy produced. Then it collapsed. In 2000, ratio hit 190%, Nasdaq dropped 78%. In 2007, ratio climbed back above 100%. Financial crisis cut the market in half. Today, sitting above 200%, higher than it was at .com peak. The ratio works because it strips away the story. It doesn't care what analysts are projecting or what a company says it will earn in 5 years. It just asks one question: is the price the market is paying connected to the actual output of the economy? Above 200%, one of the two things has to follow. Either the economy grows fast enough to justify the prices, or the prices come down to meet the economy. In 2000, the economy didn't grow fast enough. In 2008, it didn't either. Pull up the Buffett indicator right now. It's free, updated in real time at currentmarketvaluation.com. Look at where it sits today versus where it sat on 2000 and 2007. That number is the foundation for everything else in this video. The Buffett indicator tells you the market is overpriced. It doesn't tell you where the specific risk is concentrated. For that, you need to look at something sitting inside every AI headline right now, a pattern Buffett has studied closely since the last time the market priced in a future that never arrived fast enough. This is my warning sign too, the AI infrastructure trap. Buffett has said publicly that he avoids businesses where he can't see where the industry will be in 10 years. AI infrastructure is exactly that kind of bet. And the clearest case study for what happens when you get it wrong comes from the last time the market made the same mistake. In the late 190s, a company called Global Crossing had a plan that made complete sense on paper. The internet was growing, data needed to travel, someone had to build the cables. So Global Crossing spent billions laying fiber optic cable across the ocean floor, connecting continents, building the backbone of what they believed would be an insatiable global network. I found something in the bankruptcy filing from the 2002 that stops you cold. At the time, Global Crossings went under. Those cables, billions of dollars of physical infrastructure sitting on the ocean floor, were running at less than 5% of their capacity. The infrastructure was real, the demand wasn't there yet. The internet did grow, just not fast enough, and not in the way Global Crossing had bet on. The company went bankrupt in January 2002, one of the largest bankruptcies in US history at that point. Buffett watched this in real time. He didn't buy Global Crossing, he didn't buy the fiber companies or the bandwidth plays. He held cash. When the crash came, The cash let him buy real businesses at prices that hadn't been available in years. The same discipline is what built the 300 billion sitting in Berkshire accounts right now. Now look at AI. Microsoft, Google, Amazon, and Meta announced over 300 billion in AI infrastructure spending in 2024 alone. Data centers, chips, power infrastructure. The bet is the same one Global Crossing made. The demand is coming, so build now. Maybe it does come, but the question isn't whether AI matters. The question is whether returns will arrive fast enough to justify what's being spent. One or two companies will come out of this the way Amazon came out of the dot-com crash, stronger, dominant, worth holding. The rest will look like Global Crossing. For any AI adjacent stock you own right now, pull the last annual report. Find the capital expenditure line, find the revenue line. If capex is higher than revenue, you are holding a Global Crossing bet. That's not a reason to sell automatically, but it is a reason to know exactly what you own. By the way, if you want my help stress testing your portfolio against these exact signals, I walk through the full process inside my entrepreneurship mastermind, where I help working professionals build and protect long-term wealth in 3 months without quitting their job. The link is in the description below. Now we have looked at what the market is priced at and where the specific risk sits in AI. The third warning sign is what Buffett is personally doing about it, and the number will surprise you. Here's the warning sign 3, what 300 billion in cash actually means for it. Between 2004 and 2007, Berkshire cash pile kept growing. Buffett wasn't finding deals, not because they weren't companies to buy, because the prices weren't right. Every year the cash grew, and every year people ask the same question: why isn't he deploying it? By mid-2008, Berkshire was sitting on roughly 44 billion in cash. That's a lot of money. Then the crash hit. Between September 2008 and early 2009, Buffett deployed into Goldman Sachs, General Electric, and Burlington Northern at terms no one else could get. Goldman gave Berkshire preferred shares with a 10% annual dividend plus warrants to buy Goldman stock at a fixed price. GE did the same. These weren't normal market purchases. These were deals only available to someone who had cash when everyone else was desperate. You might be thinking, that's Berkshire. I don't have $44 billion. You don't need $44 billion. That's my point. You need the same ratio. A cash position built before the correction, not during it. The scale is different. The logic is identical. Today, Berkshire is sitting on above $300 billion. At the 2025 annual meeting, Buffett's own words were, "We only swing at pitches we like." Right now, we don't see many. At 300 billion in cash, that's not a passing comment. That's a deliberate signal. The number worth holding in your head right now, 30%. That's how far the market needed to fall in 2008 before the deals got interesting. A 30% drop from current levels would put a lot of companies at prices that haven't been available in the last decade. The question isn't whether a correction is coming. The question is whether you will have cash when it does. You have seen the signal, the specific risk, and what Buffett is doing about it. The fourth warning sign is the most personal because it's the one about your own holdings, not his. Here is the warning sign 4, the portfolio audit. In July 2001, Amazon's stock was trading at around $10 a share. 14 months earlier, it had been at $106, a 94% drop. If you had bought Amazon at $106 in 1999 and held through the crash, you waited until 2007 just to break even. 8 years to get back to zero. But if you had bought at $10 in 2001, you made roughly 100 times your money over the next 2 decades. Valuation at entry determines your outcome, not the quality of the company. Here's the audit to run on every position you own right now. Take trailing 12 months revenue and earnings. Calculate the P/E ratio on those real numbers. Then ask yourself one question. If these stocks dropped 40% tomorrow and stayed there for 2 years, would I buy more or would I sell? If the answer is sell, you are holding more than you should at current prices. Trim to the position you would be comfortable holding through a crash. Move the difference to cash. Before the action plan, I want to address three things you are probably thinking right now. Buffett missed the entire 2010s bull run. Why follow him now? This is true. From 2010 to 2020, Berkshire underperformed the S&P 500. Buffett said so himself. But look at the Buffett indicator during those years. It ranged between 100% and 140%. Elevated, not extreme. Today, it's above 200%. He is not being generally cautious. He is specifically responding to a number he has never seen before. You can't time the market. Nobody called the exact top in 2000 or even 2007. Buffett didn't time either. He made sure that when prices fell, he had cash to act. Timing the exact top isn't the goal. Being positioned to buy when things get cheap is. Those are different problems. AI is different. The demand will catch up. The internet was different too. Amazon survived the dot-com crash and is now worth $2 trillion. But investors who bought Amazon at the 1999 peak waited until 2007 just to break even. 8 years to get back to zero. The technology being real doesn't protect you from overpaying for it. 12 years ago, I kept my savings in a 0.01% savings account. I thought the stock market was something other people did. Then I started $500 a month into index funds. That was it. By 2016, my stock portfolio had crossed 50,000. Not because of perfect timing, because I stayed consistent and started watching the numbers. Then 2022 came, the market dropped 25%. I watched people around me panic sell positions they would held for 5 years. I didn't sell anything, I bought more. Not because I knew exactly when the bottom was, because I had been watching the Buffett indicator since late 2021. I had been building cash for 6 months before the drop started. When it came, I had capital available. I deployed it into positions at prices I hadn't seen in years. 12 years later, $500,000 in stocks, 20% average annual return. Right now, the same signals that told me to build cash in 2021 are active again, all 4 of them. And I am building cash for the second time. That's the move I only make when all 4 signals are active at the same time. So here is your action plan. 3 steps, start today. Step 1, today, go to currentmarketvaluations.com, write down the current market indicator reading. If it's above 150%, your default posture should be defensive. Step 2, this week, for every position you hold, calculate the PE ratio on trailing 12 months earnings. Flag anything above 50x. For every AI stock, compare capex to revenue. Those are your global crossing candidates. Step 3, this month, decide on a cash target. Buffett ran 15 to 20% of Berkshire in cash before 2008. For a personal portfolio, 15 to 20% in cash gives you options without sitting on the sidelines entirely. Start trimming your highest multiple positions first. You don't need to predict the crash. You just need to be positioned so that when it comes, you are buying while everyone else is selling. If you want to work through your own portfolio against these signals personally, the mastermind is where I do that one-on-one. The link is in the description below. If this video changed how you think about where you are positioned right now, subscribe. I put out finance and investing breakdowns every week. See you in the next one.